Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Good morning, everyone. So we are from group 17. My name is Kurniawan Rahman with Nabila Aura Sharani and Radia Khalida Azra. And today we want to present about stocks and shares. Such an honor for us for this opportunity. And I hope that you guys who watching this video will keep pay attention for everything what we're going to talk about. And I hope they will get benefits from this presentation. I'm gonna be the first speakers here, so let's start. Next, well, what is stocks and what is shares? So stocks, whenever a company plans to raise capital, it can issue stocks or it can try to borrow some money. They are the securities that represent a part of ownership in the corporation. Some stocks pay monthly, quarterly, or even annual dividends, which are the portion of the issuing company earnings. And then shares. What is shares? Whenever a company issues stock, each of the units of stocks is considered a share. Therefore, one of share of stock is equal to one unit of ownership in a given company. Shares are the owner of one particular company. So let's study much more about stocks and shares in detail. When an investor buys a company, that person is not lending the company money, but rather is buying a percentage of ownership in the company. In exchange for purchasing stocks in a given company, stockholders have a claim on part of its earnings and assets. And then not only do you stand for a chance to possibility receive a dividends, but if the company whose stocks you own performs well and its stock's price goes up, you could make money by selling that stocks for a price that higher than what you paid. And then those who own stocks in a public company may be referred to as stockholders, stakeholders, and shareholder. In reality, all three terms are correct. So that's it for me. And then our second speaker, Nabila Aura Sharani, will continue the presentations. For Nabila, time is yours.
Okay, I'm Nabila Aura Sharani, will be the second speaker for this presentation. And for the first material for me, I will explain about the basis comparison between stocks and shares. So let's have a look at comparison between stocks and share itself. The first one is from the meaning from both of them. So the meaning of stocks are the ownership of the company and companies. And in the other side, the meaning of shares are the owner of one particular company. And the second point, the second comparison coming from the denomination, in stocks, two different stocks of a company may or may not be having equal value, rather than in shares, two different shares of a company can have the equal or same value. So if we're talking about denomination, we're talking about like the number of shares or stocks that could have by the individual itself. And then the third point is possibilities of original issue. So what is a right issue in stocks and shares? A right issue is an invitation to existing shareholders to purchase additional new shares in the company. Like this type of issue gives existing shareholders securities called rights. With the rights, the shareholder can purchase new shares at a discount to the market price on a stated future date. The company is giving shareholders a chance to increase their exposure to the stock at a discount price. So, come back talking about the comparison between stock and share itself. In stocks, there is possibilities of original issue. The other side, shares doesn't have that possibilities of original issue. Then next to the fourth point of the differences between stock and shares is nominal value. In stocks does not have any such number of nominal value, but in shares, a share has a definite number known as distinctive number. Then the fifth point is paid up value. Stocks are nature always fully paid up, but in shares are either fully paid up or partly paid up. And the last and that is like the last point that be the basis comparison between stocks and shares. Next, I will moving on to the second material from me. It is pros and cons of investing stocks and shares. So I will explain to you for like 5 pros and 5 cons. It's like 5 benefits and 5 disadvantage of is investing in stocks and shares itself. So the first one, let's talking about the pros, like 5 benefits of investing in stocks and shares. The first one is tax advantage of growing economy. As the economy grows, so do corporate earnings. That's because economic growth creates jobs, which create income, which creates wealth. The faster the payback, the greater the boost to customer demand, which drives more revenues into companies' cash registers. The second one is best way to stay ahead of inflation. So stocks have average an annualized return of 10%. That's better than the average annualized inflation rate. It does mean you must have a longer time horizon. That way you can buy and hold even if the value temporarily drops. And the third one is easy to buy. The stock market makes it very easy to buy shares of companies. You can purchase them through a broker, a financial planner if you want to like do the professional investing, or online like iPod. Once you have set an account, you can buy stocks in minutes. It's very easy to use the app also. And the fourth one is make money in 2 ways. Like most investors intend to buy low and then sell high. They invest in fast-growing companies that appreciate in value. That's attractive to both day traders and buy and hold investors. The first group hopes to take advantage of short-term trends, while the second group expect to see the company's earning and stock price grow over time. They both believe their stock picking skills allow them to outperform the market. And the last benefit of investing in stocks and shares is easy to sell. The stock market allows you to sell your stock anytime. Economists use the term liquid to mean you can turn your shares into cash quickly and with low transaction cost. That's important if you suddenly need your money in a hurry. So let's move into the cons or disadvantage of investing in stocks and shares. So the first one is risk. Mostly people say if you are investing in stocks and shares, you will like gambling, or maybe you will come to the circle of investing high risk and high return. You could lose your entire investment, or you can really gain profits from that, and you cannot really predict it actually. So let's move to the second point is stockholders paid last. Preferred stockholders get paid first if a company goes broke, but this happens only if a company goes bankrupt. A well-diversified portfolio should keep you safe if any one company goes under. The third one is time. If you're buying stocks on your own, you must research each company to determine how profitable you think it will be before you buy its stock. So you have to invest your time, you have to learn from any platform such as YouTube or book or financial literacy itself to invest in stocks and shares. The fourth one, emotional roller coaster, because the first point you the first point I told before is high risk, high return investment. So you have that feeling of emotional roller coaster if the stocks or shares goes down, and you can like easily be happy because of your investment gain so many profit. So you have to feel in that roller coaster feeling. And the last one is professional competition, because institutional investors and professional traders have more time and knowledge to invest. They also have sophisticated trading tools, financial models, and computer systems at their desk, at their office. So yeah, you have a lot of professional competitors right now because everyone interesting of investing stocks and shares. So that's all that I can explain to you today. Let's move to the third speaker of this presentation, Radia Khalida. For Radia Khalida, time is yours.
Okay, thank you, Nabila. My name is Radia Halida Azra, and I want to explain about things to keep in mind before investing. Now that you are clear with the basics, let's see what are other things you need to consider before investing. So the first thing is understand your investor profile. Every investor is unique, hence you must ensure that you invest based on your investor profile. There are three critical factors that can help identify your profile. First is financial goals. Define your financial goals. What are you trying to achieve? Retirement, funding your world tour, planning a marriage, or even thinking of buying a house. These goals will help you get clarity on how and which stocks to invest in. Second is risk tolerance. How much risk can you tolerate? If you invest in stocks of a strong company, then the price will not move up or down a lot. It will be relatively stable. On the other hand, if you invest in a small company that seems promising, then every small achievement will boost the stock price and failure will result in a crash. You need to determine how much volatility you can handle without panicking and making wrong decisions. And last thing, investment horizon. Stock investments tend to offer good returns over a period of 7 to 10 years or long term. Based on your financial goals, determine the period for which you want to stay invested in a particular stock. Second thing is research the company before investing. Unless you are trading, don't make investment decisions based on the stock price alone. One of the best ways to find such stocks is by looking at the financials of the company. Without complicating things, simply try to assess if the company is financially sound and can withstand any economic turbulence that the future might bring. A strong company usually attracts positive investor perception and a higher stock price. Third thing is diversify. Since stock investments carry market risk, it is important to make efforts to reduce the risk of your equity portfolio as much as you can. One of the best ways of reducing risk is diversification. Here is why. If you invest in too many banking stocks and some policy change or international event impacts the banking sector negatively, then a huge part of your investment can suffer. Hence, while investing, ensure that you diversify across sectors and industries. Fourth and last thing to consider before you are investing is track your investments regularly. While many investors believe in the concept of invest and forget, investors must keep track of their investments. A stock market is a volatile place. By tracking your investments, you can identify opportunities to sell and rebalance your portfolio to maximize gains. You can also curb your losses by selling non-performing stock before they hit rock bottom. Okay, so that is the last topic of our presentation, and I will give it back to the moderator, Kurniawan Rohman.
Yeah, thank you, Radia and Nabilaura. I think that's all that we can explain to you. I would like to say thank you for whoever watching this video. Thank you for your time and thank you for your attention. And I hope that this presentation has given us new insight about stocks and shares. Thank you. Assalamualaikum warahmatullahi wabarakatuh.